Fed's rate cut decision. What it means for the market. The Federal Reserve's reluctance to indicate any forthcoming interest rate cuts has compelled the market to reassess its expectations, highlighting a significant moment in economic policy. Summary. Traders are stepping back from their predictions of a rate cut in September. Treasury yields and the value of the dollar are on the rise, while stock prices are experiencing a downturn. The positioning of investors prior to the Fed's decision may have intensified the reaction in the bond market. Experts caution against overinterpreting the market's response to a single day's events. On July 30th, 2025 in New York, the Federal Reserve's choice to refrain from hinting at imminent rate cuts, despite ongoing political pressure, reflects its cautious stance. This decision has led investors to lower their expectations for a potential easing of monetary policy in the upcoming meeting. During a recent meeting, the Federal Open Market Committee decided to maintain interest rates within the range of 4.25% to 4.50%. The last time rates were cut was in December, following a series of increases from March 2022 to July 2023, aimed at combating inflation. The absence of a clear indication that the Fed might be inclined to reduce rates as early as September has resulted in an increase in Treasury yields and the dollar's value, while stock prices have declined. Sonu Varghese, a global macro strategist at Carson Group, commented, "I believe the Fed has extended the timeline for a rate cut. They are opting to wait for more data. But this means that rates will likely remain restrictive for several more months." Currently, traders in Fed funds futures are estimating a 46% chance of a rate cut by September, a decrease from approximately 65% just a day prior, according to the CME Group's FedWatch tool. The market is no longer anticipating 2 full cuts of 25 basis points by the end of the year, as was previously expected. Fed Chair Jerome Powell was careful to keep his options open regarding monetary policy, stating, "We have made no decisions about September." He emphasized that there is still ample time to analyze a variety of data before the central bank reconvenes in mid-September. David Seif, chief economist for developed markets at Nomura in New York, noted, "There was a possibility that Powell would subtly indicate that a September rate cut was likely, contingent on the data. However, I would argue that he did not do that at all." On the same day, bond yields rose as Powell reiterated that the economy is demonstrating resilience, even with interest rates remaining modestly restrictive. Both benchmark 10-year and 2-year Treasury yields increased by about 2 basis points following his remarks. Jamie Patton, co-head of global rates at TCW, suggested that investor positioning may have exaggerated the bond market's reaction. He stated, "The market may have gotten ahead of itself, believing we had sufficient data to justify a September cut." Patton remains optimistic about short-term bonds, anticipating imminent interest rate cuts. Powell has faced considerable pressure from the White House to lower interest rates, with President Trump frequently criticizing him for being too slow in reducing borrowing costs. The Fed's hesitance to provide guidance on when rate cuts might begin will require investors to analyze 2 more months of inflation and employment data to determine the timing of any policy easing. This uncertainty may also exert pressure on small-cap stocks in the near future. The Russell 2000 Small-Cap Index, which had been outperforming the SP 500 index prior to Powell's comments, ended the session down 0.47%, compared to a 0.12% loss for the larger benchmark. For the dollar, which has faced significant selling pressure this year, the Fed's relatively hawkish stance provided some support, pushing the currency to a 2-month high against a basket of other currencies. The dollar index rose by 1%, although it remains down about 8% for the year. BofA Global Research strategists noted, "We still foresee medium-term weakness for the USD, but in the short term, the risk profile is more balanced." Higher interest rates in the U.S. enhance the dollar's appeal compared to other developed market currencies. Vishal Kanduja, head of broad markets fixed income at Morgan Stanley Investment Management, remarked, "The Fed's patience and the strength of the U.S. economy are temporarily halting the dollar's depreciation." However, Kanduja cautioned against overanalyzing the market's reaction to the Fed meeting, stating, "Overall, I believe they did not alter their stance at all." He anticipates 3 to 5 rate cuts by the end of next year, but views the next two inflation reports as crucial. They will continue to adopt a wait-and-see approach, firmly believing that inflation will experience a slight increase in the next two reports, he added. Nonetheless, they are convinced that this will be a temporary spike. This situation raises important questions. How do you feel about the Fed's current approach to interest rates? Do you think they are being too cautious, or is their strategy justified? Share your thoughts in the comments. Expert analysis. Fed's delay on interest rate cuts, its impact on the economy. The Federal Reserve's decision to hold off on interest rate cuts has sparked intense debate, leaving both economists and policymakers questioning whether the central bank is prioritizing political pressure or economic stability. Despite President Trump's fervent calls for lower rates, the Fed chose to keep interest rates steady at 4.25% to 4.5%, a move that left the president visibly frustrated. But why? Here's where it gets controversial. Some analysts argue the Fed might act in September, while others believe waiting is the right call. Thomas Aiello, Senior Director of Government Affairs for the National Taxpayers Union, explains that the Fed's reluctance stems from a desire to remain independent of the Trump administration. They needed to show resolve, proof they wouldn't bend to political pressure, he says. Even if rates were lowered by 25 to 50 basis points, the inflationary risks wouldn't disappear, he argues. We're not back to the hyperinflation levels seen under Biden, but the Fed needs to signal confidence in its decisions. Critics like Aiello also point to concerns about tariffs fueling inflation. Lower rates, he insists, would benefit consumers by reducing borrowing costs for mortgages and home construction, plus ease the burden on the national debt. Imagine paying less for loans and refinancing existing debt at lower rates, he adds. Yet, the Fed isn't rushing. They look at data over time, not just 1 month, Aiello clarifies. GDP data from the second quarter offered mixed signals. While it surged unexpectedly, declines in small business inventories and slower consumer spending raised red flags. It's not just about numbers, it's about trends, Aiello notes. The Fed also wants to wait for another jobs report, which he expects to show 100,000 new jobs. That's stronger than expected, but we need more proof of sustained growth. So what's the takeaway? Should the Fed prioritize political pressure or economic stability? What do you think? Share your thoughts in the comments below.